Hey everyone, this is Darren. Welcome to another Density Insights episode. Today, we want to cover the Canadian real estate market at a macro point of view and its outlook. In the past, we had 2 episodes related to Canada, the Toronto real estate market with Genkin and the Vancouver real estate market with Aaron. We believe it will be good to give you an overview of the Canadian real estate market to provide you a better idea of how to weigh the pros and cons among different countries. Today's guest is Robert Veerman. He's a commercial real estate broker based in Canada. We'll cover topics such as the investor's appetite under COVID-19, the macro influence, and the outlook of the market within this episode. Please let us know how you like these episodes, and I wish you enjoy and learn from it. Thank you. Hey Robert, welcome to the show.
Thanks, Darren. Glad to be here.
Yeah, I mean, this is very exciting because we're friends for so long. I think for almost 2 decades, and then it's a good time to talk about our jam, real estate. So for the audience who might not know who you are, would you mind telling them about yourself and then your work?
Sure. My name is Robert Veerman. I'm a commercial real estate broker at CBRE in Canada. Cover 2 major markets here, Vancouver and Toronto, and just buy and sell real estate for my clients.
So for the audience, right? So I used to live in Vancouver. So when it comes to Vancouver real estate, I'm always very excited because even though every time I go back to Vancouver, there's so many changes. So there's one thing that I'm sure a lot of people are curious about is that how has the COVID-19 impacted the Canadian real estate market at large, especially in Toronto and the Vancouver markets?
Yeah, for sure. I think COVID definitely has impacted everything, everywhere around the world. I'll just talk about it just from a timeline perspective. So COVID kind of first hit, or I would say the lockdowns first happened in Canada in the middle of March. So for the first 2 months, I'd say in March and April, there was just virtual shutdown of everything. And that meant for real estate as well. So for residential real estate as well as commercial real estate, I'd say all kinds of activity, trading just stopped. But what was happening in the background in a huge way was everyone was just trying to figure out how COVID and how this lockdown was going to impact their portfolios, how it was going to impact their real estate. So I was spending a lot of time with clients at that point, not buying and selling stuff, but helping them just shore up the portfolio, finding a lot of data points to understand that. I mean, real estate fundamentally is you as a landlord, you collect rent from the tenants, and then you as a landlord usually have some kind of financing on it, and you'll use that rent to pay the banks. So the fact that businesses weren't running, and there's this whole fear that people couldn't pay rent because for example, restaurants, they couldn't serve food, and they couldn't pay rent, they had no money, and the landlords wouldn't get money, and then the banks wouldn't get money, and the whole system would basically shut down. So there's this whole fear of having a liquidity crisis. That being said, the government response, federal, provincially, and municipally, has been fantastic. And they've definitely worked very, very hard to create a lot of liquidity. And I'd say overall in the industry, everyone in it, from banks to landlords to tenants to the government, have been very, very, very hands-on and very shoulder to shoulder working together to make sure things are okay. So now, I'd say since then, when we move forward to June, July, August, September, things have definitely stabilized. There's been a new norm that's set in, and but honestly, things are really back to business with COVID precautions, of course.
That's good to know because it's something that I hear a lot, and then obviously right now is September, and then a lot of places around the world are recovering. So due to COVID-19 and the economic impacts, right? Do you see a shift in investors' preference when it comes to their mandates?
Yeah, for sure. I mean, everyone has shifted their mandates. I mean, to a degree. The most flexible guys, like myself, definitely shifted my business. The private equity guys, the individual investors have definitely shifted their business. Even like the larger institutional investors, obviously they have a lot at stake. They have a lot of existing portfolio, a lot of existing assets, but even they have adjusted their outlook for the market. Generally speaking, most things have come out of it unscathed. Most guys are just in stale position. Now, there have been a few shakeups. Like 3 deals I'm working on right now are receivership deals. They're properties that where the landlord or the owner basically defaults on their mortgage and has no means to repay it, and the bank is repossessing them and forcing them to sell. And I'd say a lot of private investors naturally gravitated towards those deals. And there's definitely a frenzied activity, I'd say, from everyone across the board asking me, Robert, what kind of deals do you have, like receivership deals? Like, where can I buy 50 cents on the dollar? And those definitely did occur, mostly in the development space, because those are at the most risk at defaulting. Like, it's not a development property is not like a income property where you're just collecting rent from a tenant. Development property, you require certain things like pre-sales. You have ongoing construction, and you have much higher leverage loans. So if anything stops that for whatever reason, it can have a much bigger impact on your bottom line. So that's definitely happened. But that being said, it hasn't been the norm. Like, there's definitely more people asking for that kind of product than there is available. And the pricing, though, is like not exactly what people expected. People are looking for 50 cents on the dollar, but the reality is it's more like 70, 80, 90 cents on the dollar. Because at the end of the day, a lot of these properties are backed by mortgages from banks, and the banks will have loan to value ratios of 70, 80%, and the banks themselves don't want to lose money.
I see.
I mean, I think another big trend, I would say, is that debt is cheap, and it's definitely here to stay. And the U.S. Federal Reserve announced that they're going to keep rates low for the foreseeable future. The Bank of Canada is moving in lockstep, and financing overall is like much cheaper. It was very hard to get in the beginning of COVID because the banks themselves couldn't even underwrite what was happening. But now that things have settled down, the banks can kind of see the trajectory again, and financing is very, very, very cheap. So because of that, actually, I'd say there's 3 main asset classes that are very, very much in demand. Not like receivership type deals, but like more normal market deals. That's multifamily, industrial, and I'd say grocery anchored retail. Those are the 3 asset classes that have continued to do well through COVID, if not have done better. Just to give you a brief example, for grocery retail, I talked to a few of like the biggest grocery stores in Canada, and they were saying that their sales through COVID, from March till now, have been the highest ever on record. More than during Christmas season, more than during Thanksgiving. So their business is moving, long and short. Multifamily, people always need a place to live. And we've done a survey and profile all of our investor base who own multifamily. And I'd say 95 to 99% of them reported that they have no issue collecting rent. And industrial logistics, it has always been in vogue. It has always been popular even before COVID, and even now with more online shipping, and what have you, it just continues to be popular.
I see. So, I know you for quite some time, right? And you're quite involved with the Asian investors, such as from Hong Kong and China. How's the demand for Canadian assets fared over during 2020?
I mean, I'd say like Canada's always been a popular destination for, I guess, international capital. It's always been seen as a safe haven investment destination, not the greatest growth. Canada's not Vietnam, but it's very stable, and kind of the economy is largely backed by the American, is a shadow of the American economy as well, right? And so people have always come here. 2020, I haven't seen that much Asian interest. I think for several reasons. Mainland Chinese interest, there is still some, and we're doing a couple of deals with them, but it has not been the wave that we've seen in the past, I'd say 5 to 10 years in Canada. And I'd say one of the major reasons behind that is one, capital controls out of China. It's just harder and harder to bring money out of China. 2, it's a trade war, right? So, if you're a Chinese citizen, I think the Chinese government right now is doing all it can to make sure that capital stays in China, by either, you live in Hong Kong, if you're a Chinese citizen in Hong Kong, you pay more income taxes, living in Hong Kong than you do if you're working in mainland China. So I think the Chinese government's implementation of the global tax scheme definitely is pulling people back and having people second guess or think again about taking capital out. That being said, actually, kind of an interesting trend that I'm seeing right now, our team is seeing right now, is that we're seeing Chinese capital being redeployed into Canada, but not from China, but from other places in the world, namely the US. I think the trade war has definitely is definitely forcing some players to sell their assets in the US, whether for political reasons or just safety of their investment. Right? I think there's a general fear that having their capital in the American markets, it may not be safe, right? Something can happen to it. So we're actually seeing quite a few groups that have previously invested in the US but never invested in Canada, now looking at Canada. For Hong Kong investors, I think there was a big buzz about more Hong Kong investors looking at Canada. I'd say I'd see it on the residential scale. I think I would say a lot actually. I'd say there's a good number of Hong Kong people, who I think have traditional ties to Canada, who are, kind of redeploying back into Canada. And I wouldn't say it's more from a capital perspective, it's more from like a living perspective. I think I've had several people reach out to me asking me about jobs here, right? And with the job environment, especially in real estate, is in like Vancouver and Toronto. So I think there's definitely a migration of people, but not necessarily capital from Hong Kong.
I see. So what's your outlook for the remainder of 2020 then?
I think it's going to be I think a lot of big deals are going to happen. One of the groups I forgot to mention, actually, you asked me about Asian investors, but I'd say one of the main foreign investors in Canada right now are the Americans and maybe the Europeans. And I think for the rest of 2020, I think the pencils are back up in September. Today's September the 17th. The pencils are definitely back up in September. And I think we're going to see a lot of activity. We're going to see a lot of big activity happen in these next few months. I'd say in the next 6 months. Things may close in 2020. Things may also close in the first quarter of 2021. But I'm working on some deals. I can't disclose what, but a lot of the big players are making some big moves right now. Either they're buying, they're selling, or they're repositioning. I think what a lot of people have realized is that, we're still a peak market. And, COVID has created like a lull in the market. There's no longer much of a market force, like kind of pushing things up or pushing things down. And I think a lot of players are using this opportunity to make strategic plays that they've always planned to make, but they're executing on this now. So for the rest of 2020, what do I see? I see a lot more American firms buying up here, namely buying multifamily and office. I think the Americans have two plays up, or one play up here, and that's they know that all the tech companies, Facebook, Amazon, Google, have opened and want to open more offices in Canada for several reasons. Canadian dollar is lower. It's the same time zone as the US. It's a short flight from the US. And to get international talent, so like your top programmers from China, Indonesia, India, Pakistan, where have you, immigration to Canada is much easier. US, you have to get an H-1B visa, which is kind of up in the air right now with the current administration. But in Canada, if you have a job offer to say Facebook, for example, or Microsoft, and you're an Indonesian, for example, or Brazilian, it will take 2 weeks to process and get you working in Canada. So I think they see that as a very attractive alternative to secure that human capital. And I think the American real estate companies, are buying office based on that they know that these tech companies still want to expand. And I think they buy multifamily as well because it kind of goes hand in hand. If you have population coming in, they need a place to live. And there'll be pressures on rent growth, especially in Vancouver and Toronto. Like vacancy here is like less than 1%. So there's no new product. If one person moves in, there's like no for them to live, right? So there's a lot of pressure for rent to go up. And I'd say a lot of the big institutions as well, big Canadian institutions, which have a very, very big presence in real estate in Canada and in the world, honestly. They're one of the biggest investors globally in real estate, in China, Hong Kong, Europe, and what have you. They're going to be making a lot of strategic moves, buying and selling in Canada as well.
I see. That's very informative. So, a lot of audience, right, who actually asked me beforehand of the show is that they're interested about macro influence. What are some macro influence you think investors should be aware of in the next few years, which will impact the attractiveness of investor investing in Canada?
I think there are three things for sure. There's three main macro discussion points that people should be aware of. If you're a small investor or a super large investor, the first is interest rates. Interest rates are going to remain low for the foreseeable future. What does that mean exactly? It means that debt is going to continue to be cheap and that there's going to be further pressure for cap rates to go down. And for those who don't know what a cap rate is, it's basically it's like the income of a property, like the first year's income of a property, their expected return. So if interest rates continue to stay low or go down, there will be pressure for good quality assets, that have strong rents, for the spread between the cap rate and the interest rate to go down. I think that's one major trend that people should pay attention to. The second major trend is taxes. Through COVID, I think Canada's done a fantastic job creating liquidity, but they've also added a lot of new money to the supply. They've created a lot of new money, and and I think all of the world governments are increasing their deficits, so to speak, to help pay for this short-term instability. But at the end of the day, they need to get that money back somehow. And they aren't getting it back through increasing interest rates for, like government bonds. They're clearly not getting it back from there. I think one very easy way for them to get it back is through increasing capital gains taxes or any kind of transactional tax for investing, right? For all the people who've gotten more and more money in these past few months, it's the easiest way to get it back, just to tax them on their investments. So I would look out for any kind of sign of capital gains tax increase. In Canada, their budget is being put forth next year in the spring, in Q1, Q2 of next year. So that's definitely a thing to watch out for. And I think a lot of the moves people are making right now is potentially in anticipation of that. I think if capital gains goes up, if any kind of transaction tax goes up, there'll just be less trades. It won't make the underlying value of the asset or the real estate worth less. In fact, it'll make it worth more, because for anyone to sell, they're going to have to sell for more to get a certain return if their taxes are up. So I think it'll make things more expensive for good quality stuff. Obviously, for stuff that's not desirable or has issues, then that stuff will probably go down. But for stuff that's super desirable, multifamily, industrial, super stable, super safe, grocery, those will be harder and harder to trade. And the people who own that stuff will probably be in the best position. I'd say the third trend is immigration growth. Another way that I'd say the Canadian government can pay for a lot of this deficit, and the way it historically has, is just through immigration. And that's and immigrants bring money, they bring capital, and they also, increase the GDP of the country. So I think that's generally a positive sentiment for Canada, increase immigration, because that will increase growth overall. So I think that's another major trend to look out for.
That's very informative. I think that everything you said so far is very in-depth. Thanks for your time. So for time being, right, what are some ways that if someone watched this video, want to ask you more about questions in commercial real estate or as a whole, how would you suggest them to reach out to you?
Yeah, just I'm sure my contacts will be above or below. Why should someone reach out to me? I'm a commercial real estate broker. Work at CBRE. We're one of the largest, actually the largest commercial real estate company in the world, full service real estate company. We have a lot of different business lines, from investment to capital markets, leasing, property management, asset management, the whole gamut, appraisal. Myself, I work on the investment side as a broker. If you have any questions regarding commercial real estate, or in fact, commercial real estate in Canada for that matter, feel free to reach out to me, send me an email, give me a phone call. I think for people that don't know real estate, and perhaps they're on DENZITY, looking for more insight into real estate and how to get into it, I would say this: it's a great asset type, it's a great investment to get into, and you can start very, very small. I'd say some of the biggest portfolios have been built from one small building. Using, I guess, a celebrity as an example. I went to school down in LA. Everyone always used to talk about Arnold Schwarzenegger. Arnold Schwarzenegger is an actor. He's this guy. He came from Vienna, from Austria. He started buying commercial real estate, apartment buildings, actually. When he first started. And you buy one, and then you refi it a few years later. Then you buy another one, use that money to buy another one, and you just keep rolling, right?
Yeah, I think he covered a lot about his real estate deals in his book Total Recall. So it's very interesting because he makes his money before his acting career kicks off. So it's
exactly right.
Yeah, and then obviously, right? I think real estate, obviously, I love the sector, and that's why we're here. And I want to give a shout out to our high school, St. George's, that's how I know you have become friends. And at the same time is that. Yeah, so I'm sure I want to do round two. We can get other people our friend Danny, who as a pension guy, is an investment manager, to talk more about investing as a whole in real estate or even fixed income assets. So I want to say again, thanks for your time, and I really appreciate your time in making this happen together.
Will do. Thanks.
Okay, see you next time, Dan. Thank you. Good day.
Cheers.
Bye. Thanks for watching. What do you think of this episode? Please let us know in the comment below, and Be sure to hit the subscribe button to keep in touch with us for upcoming videos. But before we go, I want to give a big shout out to Patina Design Lab. They're the one who help us in making our brand, our direction, as well as these videos. They are a strategic design consultancy firm that help businesses with a wide range of design services, from industrial design, branding, graphic design, art direction, content creation, and many more. They are a very talented bunch, and I urge you to check out their website for their work. That's all for today, and see you next time. Cheers.